Hello, I'm Richard Murphy, and I've made two videos which I hope you will watch before this one, to be honest. One is on the problem we have with accounts in 2021, and the other is the problem we have with audit in 2021. Accounts don't meet people's expectations because they're only designed for the use of shareholders looking to decide whether to buy or sell their shares in a company. And very few people are ever actually looking to do that. The vast majority of users of accounts are not in that position, so the accounts aren't designed to meet their needs. Audit is currently designed as a tick-the-box exercise to say, have the accounting rules that prepare accounts for the benefit of shareholders looking to buy or sell their shares in the company been met? And if they have, they're true and fair, and if they haven't, they're not. So there's a very limited aspiration on the part of the auditor to determine what is a true and fair view. Now, the government is concerned because there have been some significant company failures in recent years. Carillion in the UK, a major outsourcing contractor. BHS, obviously somebody who was on the high street for, over 100 years and then failed. Patisserie Valerie is another one that failed after a fraud. In Europe, there's Wirecard, which also failed after major frauds. And these things have caused scandals because obviously people have lost jobs, people who've invested in the companies have lost their money, and the government has had to pick up the bill on occasions. There's, for example, a hospital in Liverpool which Carillion was working on 4 years ago, that is still sitting incomplete as a result of the failure of that company. So there are sometimes very real costs in society for audit failure, if audit failure it is. Now, the assumption is that what we are seeing is audit failure, and what we are seeing is a failure by the big four firms of auditors who audit almost all the large accounts of companies in the UK, and that they are responsible for what is going on. Those big four firms are PricewaterhouseCoopers and Deloitte. Those two are pretty much neck and neck in size, and they're larger than EY, which is third. They used to be called Ernst & Young. And the fourth largest is KPMG. I should declare an interest. 40 years ago, I worked for what is now KPMG, but that's a long time ago. Those four firms dominate this market. There are 10 or so other firms who are called the challenger firms, who are much smaller, who could potentially do some audit work. The government believes that all the problems in accounting come down to these audits and the fact that they're not done well. I have read the government's consultation document on the future of audit published a couple of months ago, and on which the consultation closes at the beginning of July. The consultation document is of 232 pages. There are 92 questions in it. Just downloading the questions is 3,500 words. I'm replying to that document. It's a pretty hefty exercise. My point is that if we stand back from the whole exercise and look at what the government is asking, they've got pretty much everything wrong. And that's because they assume there is a profession called auditing, and there's a profession called accounting, and that these two professions don't overlap. I'm sorry to say, but they do. And it's very obvious that they do. Why? Because auditors express opinions on accounts. And if accounting rules are wrong, nothing that an auditor can do can put the deficiencies in the accounts right, unless the auditor is liberated to do so, which is not true at present, and is liberated to do so by exercising their judgment, which they did before around 2000, by doing something which is called a true and fair override. In other words, they say, although the accounting rules require that a transaction be recorded in this way, unless it's done in another way in these accounts, I don't believe a true and fair view will be delivered. And it takes a very brave and candidly a pretty risky, in the sense of risking losing the audit contract, auditor who's going to stand up to their client and say, I want you to break accounting rules because I believe there's a better outcome that could be offered by literally doing it a different way. And that is the problem that is implicit in the whole review that is going on. The government is presuming that the accounting rules are right, and the problem is only with regard to the way in which those rules are audited. I don't agree with that approach. The rules themselves are wrong in a great many ways, and yet we are seeing throughout the consultation document that when there are issues which I know as a researcher, as a chartered accountant, as somebody who teaches accounting on occasions, when I know that those things actually are deficient, the actual consultation document reinforces the status quo. Let me give you a simple example. Some companies have failed because they paid out too many dividends. And I and my colleagues at Sheffield University and elsewhere have been looking at a concept which we call a hollowed out firm. A hollowed out firm pays more dividends than it can because of the profits it appears to have earned as a group. This is possible. It can be financially engineered to achieve this. There are many ways I'm not going to explain here. But the point is that necessarily creates audit risk, because if you pay out more dividends than you've earned in profits, in theory, the value of the company must go down. And you must therefore put pressure on the balance sheet of the company by having to borrow to make good the deficiency of cash that you've created by paying out too many dividends. If you borrow more in proportion to the scale of a business, you create risk. The chance of the business failing increases. And so you would have thought that this was the perfect moment for the government to put in place a review to say, we'll change the complete way in which we review the way in which dividends can be paid. We will base the payment of dividends upon the group's result and not on the results of the parent company of that group, which, by the way, are different, even though theoretically they're the same company. The parent company of a group keeps two sets of books, one for the group as a whole, one for itself. It's the one for itself that determines whether dividends can be paid, and it's easy to manipulate the result inside a group parent company. It's hard within the group, but they pay them out on the basis of the group parent company. Is that deficiency being challenged by the audit review that is going on? I'm afraid to say it isn't. The one thing that they've made absolutely clear is that that difference will be in place. So my point now is quite simply that we're doing a review which is not going to achieve an outcome that is going to be useful, simply because there's been a lack of willingness to question, are the accounting rules which underpin the reporting which auditors have to form an opinion upon good enough and fit for purpose? They're not. But the government isn't willing to say that. And so, I'm afraid to say, this audit review is not going to work. I have another video to make in this series. It will be, what could we do? Join me for that one soon. Thanks for watching. If you're interested in what I've been saying in this video, please subscribe. There is a button below the viewing screen. If you're interested in what I have to say on Twitter, I'm at Richard J. Murphy on that medium. If you want to look at my blog, that's taxresearch.org.uk, and we have a Facebook page as well, Richard J. Murphy. So one of those things will get you more information on what this video series is about, and I hope I'll see you again soon.